Welcome back to Everything Money. It's Seth, Paul, and Mo. Paul and I are both on a little bit of a weight loss challenge and doing good. And Mo is always on a weight gain challenge. He's look at those abs and biceps. He's pounding his chest
Seth?
like an ape. This morning, 248.4.
So what's the total loss there?
26? A little under 22. 22.
Oh, 22.
So
You were at 270?
I have 18 to go. Yeah. I'm good.
So you okay? Gotcha.
I got 18 to go.
Good.
Yeah. Today we're talking.
I'm at 6.3 pounds.
You're looking great, Paul. Everyone knows it. The Noom. Everyone knows that Nike is incredible. We all have Nike shoes. You probably have Nike shoes as a viewer. Paul, it's such a crazy story. I started reading that Phil Knight book.
Oh, you did? Shoe Dog.
Nike, listening. And you know what's crazy, Mo, is the guy who reads the book. I don't know if it's Phil Knight or not on the audiobook. I can't stand his voice. I gave up on it. I can't take it. My wife loves it, but I can't. But regardless, Nike as a company, phenomenal. They got the Jordan brand. They got the LeBron brand. They got everything. It's amazing how the reach of Michael Jordan, how much astronomical numbers of where a basketball player from 30 years ago can be on the football jersey of a Michigan team. It's just,
he was the first. Michigan was the first team to sign with Team Jordan.
It's crazy how the reach is like inner sports. But regardless, we want to separate the company from the company stock. Two very different things. And if other channels are telling you they're one and the same, it's not always the case. We have multiple examples of this. So even though Nike might be slaying it with sales, which who knows if they are, we'll take a look. They might not be slaying it in terms of a ticker price. So we're going to determine, is this a good stock to buy? What is a good price to buy Nike stock in terms of value investment? In this video, we'll also take a look at our 8 pillars to see the fundamental financials behind the company. And if you're interested in trading Nike, by the end of the video, we'll go over to Mo so you can trade if you're in the Bidnast Nation in the Everything Money community and you're trading on a daily basis. Is this something you want to trade? So I introduce you to the seer of seers, Paul Gabriel.
All right, guys, before we go, please follow us on Instagram. We love it. We appreciate it. So Nike, guys, I've always loved Nike, and you'll see it in the financials. I've always loved Nike's financials. They keep, from last time I remember, and I haven't looked at them in a while, they keep a great balance sheet. They're very positive, very good positive cash flow. That's what happens when you hire 7-year-old Malaysian kids to make your shoes.
That's right. Now, I would say, Paul, we just read a book, The Psychology of Money, which they describe that as an American, when someone over in Indochina is making our shoes for 7 cents a day, prior to that, they might have not had the greatest job. And some people, actually, these jobs are somewhat desirable for people.
The example was what somebody wrote. You know, everybody talks about these terrible sweatshops, these terrible factories, but my aunt was working this factory and her life was so much better because before that she was a prostitute.
Yeah.
And now she's working in a factory getting money that's consistent, and you guys criticize it and we love it. So anyhow, let's look at Nike. Big company, $250 billion market cap, okay? 5-year PE, look at this number, Seth. We want under 22.5, it's at 68. And the current PE is 44. So already feeling more expensive, right? But 5-year return on invested capital, this is what you love to see. We want over 9%. This is 14.2% on the last 5 years. Guys, this is a lot. This is incredible. So it shows that they take their capital and invest it very well and get high returns on that investment. That's what you want going forward. And that's what you're willing to pay a premium to get. So we're looking at it saying, let's not be anal about these PEs and price of free cash flows if they're able to consistently earn a high return on their extra capital, right? So far, 1x and 1 check. Small dividend, 0.7%, nothing big, but it takes out 1.6 billion of their $6 billion last year and their 5-year average of 3.76. So these are just the things we look at along the way.
As Warren Buffett always says, we're buying a business, not a ticker. So we need to look at the fundamentals in terms of financials. What do they make? Paul, I drive around thinking about all these YouTubers that suggest these crazy ass stocks, and they never go into what the hell does this company make? What
it doesn't matter. It's just where the stock's going, but we disagree.
Revenue growth over the past 5 years is pillar number 3.
So 34.35 to 44.54. Now that's a check mark. I remember around this area, I remember reading a report where Nike wanted to double their sales over the next 10 years or 5, some big number. I was like, oh, that's impressive. Because remember, they're at 30 billion or so. They wanted to go to 60 or 70. So we have a check mark there.
What we saying, goal for 2021 was to do 50 billion in revenue.
Yeah.
But unfortunately, supply chain issues are going to mess that up, I think.
Yeah. So, all right. So there's going to be an issue. That's all over the world.
Yeah.
Profit numbers, 4.24 to 5.73, which I'm surprised it's not as big a bigger jump. but a couple drops in the middle. So, okay, it's inconsistent, but this is where we look at free cash flow to be better understanding.
Pillar number 5 is shares outstanding, Paul.
1.65 to 1.58.
Oh, they're buying
All right,
back.
so, but over the last 10 years, they went from 1.83 down to 1.58. So here's what I'll say. A company like Nike, if you buy them and you want to hold them long term, this is what I love. I love a company like Nike. High gross margin. I believe their gross margin was, let's see what their gross margin is. Their gross margin is 45%. So for every extra dollar they bring in revenue, they're generating an extra 45 cents of that to the bottom line. Now, when they're buying, as they grow and grow, as this company becomes bigger and bigger, the only way to it'll be harder and harder to reinvest that capital into higher generating revenue, right? So the question becomes, at what point do they start massive stock buying back, right? And that's what I like. So I look at Nike saying, if you can buy it at the right price, where it's giving you a good return, and then also as it grows, it starts buying back shares, I think you can make a really high return on your invested return on your investment if you do that.
If this resonates with you and you finally want to grasp the financials of a company, understand the true stock ticker price, you can have the power in your hands right now by joining the Everything Money community, either on Patreon or everythingmoney.com. You can have this software, you can have the stock analyzer tool, you can trade with Mo on a daily basis and get that understanding you've been yearning for years. You can finally grasp it right now. Tell them about it, Paul.
Guys, mobile app, 8 pillars. This whole entire website is on a mobile app. 8 pillars, 30 years of financial data, stock analyzer tool, exclusive daily content will be coming to you, 1 or 2 videos a day, access to 3 of us, real estate calculator, stock screeners, retirement calculator, but big and not bigger, Discord community. Over 5,400 people in our Discord talking every day about investments in an organized fashion. All this is yours for a measly 87 cents a day. I got my brother a cup of coffee from McDonald's that costs more than that this morning, and you get all of this versus our competitors at $200, $235. No brainer, guys. Value deal of the century. If you believe in your learning better and getting higher returns for 87 cents a day, if you don't see the value in that, I don't know what we're doing here.
Sure enough, Paul, we had a little cookout for the Browns game on Sunday at my house, and our dear friend Mike, who was hesitant to even invest anything, Mo, is now telling other friends about the bid and ask, about...
Does he like the bid and ask? Is he being active?
He's trading, he's active.
Is he?
Which is funny because he's an anesthesiologist, he's in the OR. But
And sure
he's
enough,
active.
Mo, I think he's already surpassed me with his knowledge of options and everything. I was like,
Really?
boy, I was begging him to get on board with this, and sure enough, he is. So,
Yeah,
all right, Paul,
very
let's get back to Nike.
All right, so the next...
Pillar number 6, go ahead.
Yeah, the next metric is something we just added recently. What we're trying to do is see how long it would take them using their average free cash flow to pay off all their long-term liabilities. So if you remember, their average free cash flow in the last 5 years was $3.8 billion or so. We want that to be we want their total liabilities to be under 5 times that amount. So that would make it $19 billion we want their total liabilities to be under. Total liabilities, 15.3, so that's a check mark. So they have less than 5 times their 5-year free cash flow to pay off their debts, long-term liabilities.
Yeah, speaking of, let's look at that free cash. We want this going up, free cash flow growth over the past 5 years.
Now, guys, only on our software, we added this line to save you guys on the math, because most financial statements do not have this line. Actually, all of them don't. $2.75 to $6 billion in free cash flow with an average of 3.76, call it 3.8. We usually pick a multiple of 20 to multiply by as a starting point. So we want a market cap of $76 billion. It's currently $250.
Oh boy.
Yikes.
That's an X. So, is this company expensive? From the 500-foot view, it is. But what we're going to do next is we're going to put them in the stock analyzer tool after Mo's done, and we'll see exactly based on growth rates and other assumptions, what are we really paying? Is it really too expensive or not? And we'll find out.
Mo, were people trading this in the bid and ask?
I know I am. I've been super excited about this for a long time. Since this gap up happened on earnings back in June, that was it gap from 133 to wherever it's at today, 157. So I have been hoping, because 90% of the time gaps fill, and I kept saying this gap is going to fill. And today, for the first time, they've turned into a downtrend, meaning that their percent K has moved into the sweet spot. So it's not that I'm going short on it today. I'm going to wait for confirmation, because this thing could very easily just go right back up with a lot of buying volume coming in. So I'm going to wait for confirmation, and I'm going to enter this thing, and I'm going to catch this thing short down to $133, because this is a good looking short. I've been so excited about this one since June, and it's been on my watch list every single day for that reason.
You know, Paul, the next book I'm going to read is Manish Pabrai's The
Dando Investor.
Dando
So
Investor.
good.
But after that, I really got to get back. And you really sparked my mind about the complete turtle trader.
Oh, yeah.
And following the rules. We have some friends who are super rule followers. So I just got to, this is my mission coming this winter. By Mexico, we should really be talking about this in January. So
Yeah, it'd be fun. Wouldn't it be fun in Mexico if we're looking at this stuff every day?
Yeah.
let's look at the stock analyzer tool. You can get this analyzer tool as a part of our Everything Money community if you join. And this really is the final piece of the puzzle. We've looked at the financials. What do we pay for this? We need to say, what are we going to pay and what do we want to make out of this stock over the next following years? Go ahead, Paul, tell them.
So guys, you know, one of the major aspects of value is growth. So people always think value means no growth. Quite the opposite. If I have two companies that are exactly the same, exact same industry, one's growing 20% a year, one's growing 10% a year, which one am I going to pay more for? I should be willing to pay more for the 20% growth a year. So what we do is we're looking, I actually usually do a 7-year analysis, but with Nike, I did a 10-year analysis because I don't think Nike's a company that you're buying and then once it hits its price target, you'd get rid of it. I think it's one of those moats that Warren Buffett talks about where if he could buy this company at a much cheaper price, he would because it is the ultimate of moat. I mean, I really think it's the ultimate. I mean, when you ask, Under Armour for a while there was surging and then all of a sudden they fell apart.
Just look over the past 2 decades. Under Armour, Under Armour, Reebok, Adidas, they try to infiltrate and they can't.
Nike does a great job of it.
Yeah.
So what the stock analyzer tool does, it'll give you your historical levels, 1, 5, and 10. So what I try to do is I try to be conservative. Why? Because you're an investor, you work too hard for your money. Why go overpay for something? So I put 3, 5, and 7% growth rates. Is that low? Is that high? I don't know. But at 7%, you're going to double every 10 years on your revenue. That's pretty solid. Share change. Even though they increased in the last year, I still assumed -0.5, -1%, -1.5. Profit margin, apart from last year, I'm doing 9, 10, and 11. Same thing with free cash flow as a percentage of revenue. Looks pretty consistent as their profit margin. Now, here's the kicker. Current PE is 68. I went 12, 15, 18. Current price to free cash flow is 42. I went 12, 15, 18. Those of you out there will say, oh, that's too low. Guys, this is a direct reflection to me of growth and what you think of the company. Now, do I think you could pay a premium for Nike? Yes, I do. So I'm just sitting here saying to you guys, I'm going to alter this to 15, 16, and 18. Sorry, 15, 16 and a half, and 18. And here's why. Nike is a company that you should pay a premium for based on their brand, based on their staying power, based on their quote unquote moat. I don't believe in paying the market. Now, do I still want to buy it for the market price, hoping that we think it's worth more? Absolutely. So we hit the analyze button. The stock is currently at 160. And this is very obvious. We have a middle price around 50, a high price of 80, low price of 30. Guys, this is just math. You might think, no way will Nike fall in half. Okay, maybe it doesn't.
Oh, Paul, when it fell during the March of COVID 2020, it was $62. It was 60% less than this.
It got to $60 on the nose.
So I look at this saying, if you want to go overpay for Nike, but guys, at the end of the day, it's just math. If you pay 160 for Nike, I can work this a different way. Let me go assume 5%. Let me go assume a 5% return. So it'll tell me what I need to pay for the company to get a 5% return. $81. Guys, it's not looking good. 3% return, 96. So basically what you're saying here, if you want to break even, 120. If you buy the stock currently at this current price, and if you believe over a long period of time, free cash flow and earnings will yield the value of the stock, you're actually going to lose money buying it at 160. Because even breaking even, 0% return, you still have to pay 123 for it. So it's just math, guys. At the end of the day, this is all just math. Now, I like to put in these 15, 12 and a half, and 10, but focus more on the middle numbers. And I'm looking at $50 a share, roughly, for me to buy it, to beat them, to get a return. Now, maybe I can alter my revenue. If you sit there and say, Paul, you're crazy. They're going to grow at 5, 7, and 9%. Okay. It's still only a $55 stock. I increased their middle growth rate from 5 to 7%, and it only went up $5. It's just math.
Yeah, Warren Buffett says, when asked how to invest in companies, he says, "This is a great company." The answer is yes. Is it cheap? The answer is absolutely no.
This company I don't view as cheap.
It's not cheap.
So let me even do it. What growth rate does it have to have in order to justify this current stock price? Look at this. On the high level, 18% growth rate for the next 10 years. So at 10 years, 18% growth, that makes the revenue 235 billion in 10 years. It's currently at 45 billion. Do we think that's realistic? Do we think that's probable?
You tell me, baby.
No, I don't think it's probable that the company goes from
They're
45 billion in revenue.
Yeah,
and they're already everywhere. You know what I mean?
Yeah, so.
So I just look at it saying, guys, just add Nike to your watch list, because I look at Nike saying this is a great company, great financials, but valuations are out of whack. That's it.
Yeah, there's gonna be comments below that these guys don't buy anything. That's true. There's thousands of stocks, and we want like the 20 or 30 really great buys. This is currently not one of them, but patience and discipline is the key. And when the world starts crashing down, come back to our channel and see that the live streams are going bonkers, because that's when our time to buy. Go ahead, Paul.
And not just when the world comes crashing down, when things start to not make sense as to why it went up or down. That's it. We can explain why things went up or down, or we can sit there and say it's okay if it went down because of this. You know, somebody in the Discord yesterday asked, Paul, have you ever seen a stock that looked like a value play and didn't work out? I'm like, it happens all the time. It happens all the time. But 20 or 30% of value plays that you see actually are value plays. The rest of them are cheap for a reason. So guys, thanks for watching. Follow us on Instagram.
Yeah, fondle thumbs up on the way out and join the Everything Money community. Thanks for watching. See you next video.